And I'd like to call the meeting to order.
A corporation's board of directors is directly responsible for dividend policy, which is influenced by a number of factors.
Deciding how much of a dividend is a key thing. You want to have as large of a dividend as you can if you're a mature company without ever getting into a risk of causing yourself a capital problem, i.e. not being able to pay the dividend, or B, ever being in a scenario where you might have to reduce it. To pay a dividend, as you say, you have to have retained earnings and you have to have the cash. And that's another reason why the dividends tend to be smaller with companies, because if you pay the dividends out to shareholders, you can't use that money to invest in your business. If you're a retired investor, you're looking for current income. You're not really looking for appreciation in your stock. So a dividend is very important. And there's certain stock funds that require dividends before they even would buy a company and invest in the company. So dividends open you up to a larger portfolio. From a corporate point of view, you always look at cash versus stock dividends. And what you'll find is a corporation that doesn't have a lot of float, i.e. it doesn't have a lot of its stock outstanding in the market, they'll pay frequently a stock dividend. It does two things. One, it doesn't cost them any cash. And two, it gets more stock out in the market. And the broader you have stock in the market, the more mutual funds and the like can buy your company.
A board of directors may also increase shares of outstanding stock by declaring a stock split.
With a stock split, the most common probably being a 2-for-1 and the easiest to understand, you'll typically see on the day it is announced, the stock price will move from, say, 50 to 60, and then when it's issued, the stock will be cut in half from 60 to 30. But you've still got a big appreciation. At Centex, we've used a stock split more than a couple times in our history. Most recently, we split our stock 2-for-1. And in our case, what our stock had done is run up to the $80 a share price, and we wanted to bring it back down to, we typically like seeing it trading in the 20s, 30s, 40s, because the investors tend to buy more aggressively there.
Dividend transactions need to be recorded before their effects are reported on a company's financial statements.
Let's examine what's involved when the board of directors determines that they're going to give a cash dividend. First of all, there are 3 dates identified here. Number 1 is the date of declaration. This is the date where the board of directors says we will, at some given date in the future, distribute dividends. At that point, they have a legal liability to follow through on that promise to distribute these dividends in that date in the future. They must record the decrease in retained earnings and this legal liability. Now we get to the next date. This is the date of record. Whoever owns the stock on this particular date will receive the dividends on the date earmarked for distribution. There's no accounting implications on the date of record. It's just a matter of getting a list of stockholders of record on that date. The third significant date would be the date of distribution. And now we will send the checks to all those stockholders of record. This is a rather obvious accounting implication. We're satisfying a liability. Our liabilities decrease, and obviously this is a cash dividend, so our asset cash decreases.
Accounting entries for the payment of a cash dividend begin on the date of declaration. Cash dividend declared is debited for the amount. In this example, $5,000. And common dividend payable is credited for the same amount. No entry is required for the date of record. On the date of distribution or payment, the entry is to debit common dividend payable and credit cash. Finally, at the end of the reporting period, the balance of the cash dividends declared account is closed, which also reduces retained earnings. As we've seen, cash dividends reduce a corporation's assets and equity. However, stock dividends do not affect assets or stockholders' equity.
Now take a look at stock dividends. We have a situation where a corporation is very profitable, but they have other plans for their cash right now. They do not want to distribute cash right now. They want to give something to the stockholders. So what do? They have authorized shares that are available. They distribute those shares of stock for free to the stockholders, regardless of the size of the dividend, whether it is a small stock dividend or a large stock dividend. The net effect is exactly the same. We have a reduction in earnings equivalent to whatever we evaluated that dividend at, and we have an increase in the stock accounts, leaving the corporation in the same financial position, just a shift in the components of equity.
Note that the total amount of equity remains the same, regardless of the size of the stock dividends. Retained earnings decreases and contributed capital increases.
Any dividend between 1% and 25% of the outstanding stock would be considered a small dividend. In that case, we use the market value. That is considered to be a fair evaluation of this stock. But what happens if the corporation chooses to declare what we would deem a large stock dividend, something greater than 25% of the outstanding stock? Here we have in the hands of all of our stockholders a great number of additional shares that they receive for free. Maybe the market will be flooded with a great amount of additional shares at a particular point in time. What do we expect that's going to do to the market price of the stock? It's definitely going to reduce the market price of the stock. So would market value be a fair evaluation of that event in that case? Obviously not. So now we're left to find another way to evaluate the dividend. If it is a large stock dividend, we simply use the par or stated value.
How about journal entries? First, consider small stock dividends. Assume that 100,000 shares of $1 par value common stock is outstanding. The board of directors decides to give a 10% stock dividend. The market value of the stock is $5 per share. On the date of declaration, stock dividends declared is debited $50,000, the market value of the shares to be issued. Common stock dividend distributable is credited for the total par value of $10,000. The rest is credited to contributed capital in excess of par value. On the date of record, there is no transaction, so there is nothing to record. Finally, the date of distribution. The stock is actually distributed to stockholders. Common stock dividend distributable is reduced with a $10,000 debit. Common stock is credited $10,000. Now let's look at the same company but with a more generous attitude. Instead of the 10% dividend, the board declares a large stock dividend, say 40%. Remember, with a large stock dividend, we use par value to record transactions. On date of declaration, debit stock dividends declared $40,000, the total par value of the stock, and credit common stock dividend distributable $40,000. On the date of record, no transaction and no entry. The last entry is on the date of distribution. Common stock dividend distributable is debited $40,000. Common stock credited the same amount, $40,000. As with cash dividends declared, stock dividends declared is closed into retained earnings.
Let's think about a stock split for a moment. I'm sure you've heard that terminology. You read it in the financial press all the time, stock split. What does that mean? Not very much at all. Because there's been no additional investments. We do not have any additional assets. There is no additional equity. It's more or less a paper transaction. What happens is the par value of that stock is changed accordingly. Let's say we had a 2-for-1 split on a $100 par value stock. Well, that stock will now carry a $50 par value. Because remember, the balance in the stock account has to equal the par value of the outstanding shares. So if we've doubled the outstanding shares, we now have to show the par at half the original amount. This is often done by corporations in an attempt to make their stock more marketable.